Hello everyone, I am Dr. Soundararaj. Through this video, I am going to explain the procedure to be followed for preparing funds flow statement. I will explain the procedure by using a problem. This is a small introduction about me. If you like the video, give a like and do subscribe my channel as well. Now look at the problem. The comparative balance sheet of Unbarasan Limited are given below. Balance sheets are given for 2 years, 1998, 1999. Don't worry about the period. It is for 1990s. That doesn't matter here. You can assume that it is for 2018 or 2019 as well. I am here to explain only the concept. So I make sure that you learn the concept properly and try to solve any type of problem that comes in funds flow statement. That is what my objective behind releasing this video. Share capital, profit and loss account, bank loan, current liabilities, provision for tax are given. See, among these items given in the liabilities, current liabilities are the only thing that should be taken over to the schedule of changes in working capital. For provision for tax, if there is a kind of additional information or adjustment to be done, we can prepare a separate ledger account. So better you keep it as what? A non-current liability. So take current liabilities alone to schedule of changes in working capital. Go through the asset side. Fixed assets. Net value is given 1 lakh, 1,10,000. Stock, trade debtor, cash at bank. These three are current assets. Preliminary expenses opening 15,000, closing 10,000 given. Therefore, you find a decrease of 5,000 rupees in the preliminary expenses, which is nothing but preliminary expenses written off during the year. It would have been considered in the profit and loss account. Now, followed by you are given with the income statement of the company for 1999. That's a current year in this problem. Sales less cost of goods sold, gross profit is given. Operating expenses are given separately, depreciation, administration and selling expenses, then they have calculated operating profit. Less non-operating expenses and losses, there are two items given, preliminary expenses 5,000, provision for tax 22,000, it comes to 27,000. So profit after tax is amounted 83,000. See, I used to say clearly that operating profit lies in between gross profit and net profit. Gross profit and net profit. Operating profit before depreciation. Operating profit before depreciation could be named as funds from operations. Where there is one particular expenditure which is an operating expenditure but a non-fund expenditure, to be adjusted with net profit for the calculation of funds from operations. So please understand this fact. Though operating profit lies in between GP and NP, if you want to name operating profit as funds from operations, that operating profit should be of what? Before depreciation, which is a non-fund expenditure. So that you keep in your mind. Now you are required to prepare statement showing changes in working capital, funds flow statement. As I said, there is one item of current liability, 3 items of current assets. Now again, I help you to recall the 4 formula I used to explain in my videos. 1. Increase in current asset leads to increase in working capital. Decrease in current asset leads to decrease in working capital. Increase in current liability leads to decrease in working capital. Decrease in current liability leads to increase in working capital. These 4 formula you have to memorize. Keep yourself very thorough with this 4 formula so that you can prepare the schedule of changes in working capital without any difficulty. Now look at the schedule of changes in working capital. You find in stock and trade debtors increase in stock and trade debtors. So increase in current assets leads to increase in working capital. Whereas in cash at bank there is no change. Find regarding current liabilities, you find 65,000, 80,000. Increase in current liability leads to decrease in working capital. So on the whole, the result of schedule of changes in working capital comes to what? 25,000 rupees increase in working capital in the year 1999 compared to the year 1998. Now we will look at the funds flow statement finally, look at the workings. I am sure the working should have been done for provision for tax, then the fixed asset account. For these two accounts, they would have done workings, ledger accounts. What about adjusted P&L account? In this problem, it is not required. We will calculate funds from operation very easily even without preparing the adjusted P&L account. Look at the fixed assets account. Opening balance return is in the debit side because assets are all debit balances. Closing balance is written in the credit side. Simply the figures that are given in the balance sheet asset side are picked up and written here. Depreciation, if you look at the income statement, they have given depreciation amount at 20,000. See, so that is what. So depreciation account debtor to fixed assets account. Depreciation asset account debtor to fixed assets. Now listen to me. The opening balance of fixed assets was 1 lakh. Deduct depreciation 20,000. So the expected closing balance is only 80,000. 1 lakh minus 20,000, it is supposed to be 80,000. But the actual closing balance is 1 lakh 10,000. So there is an increase of 30,000 rupees in the closing balance of fixed assets, which is nothing but purchase of fixed assets. That's what the balancing figure in the debit side of the ledger. So what is a journal entry for purchase of fixed assets? Fixed asset account debtor to bank account. Followed by provision for taxation account is open. This being a liability item, it should have credit balances. So by balance brought down, the opening is written in the credit side. Closing is written in the debit side. Now, according to the problem and specifically the income statement, provision for tax made during the year is 22,000. What is the journal entry for making provision? Provident loss account debtor to provision for tax. So what is that? Provident loss account debtor to provision for tax. See, by provident loss account. So provident loss account debtor to provision for tax. So it is 22,000. Now listen to me. Opening was 20,000. Now they have added 22,000 more. So the closing is supposed to be 42,000 if nothing else has happened. But the actual closing is only 25,000. 42,000 minus 25,000. What is the difference? The difference is 17,000. So 17,000 rupees is missing from this account. It has gone out in the name of tax paid. The tax paid is again a payment. It will come under in the funds flow statement under application of funds. 17,000 rupees tax paid will be recorded as application of funds in the funds flow statement. This 30,000 rupees purchase of fixed asset will be recorded as application of funds in the funds flow statement. These two items will appear in the funds flow statement with regard to these two ledger accounts. Now let's look at the details here. Please listen to me carefully. Opening profit and loss account 80,000. Closing is 90,000. Along with the opening, if you add the current year profit 83,000. So 80,000 plus 83,000, the closing is supposed to be 1,63,000. But look at the closing, it is only 90,000. So where is that 73,000? 73,000 rupees is missing, there is no account for it in the problem. So you can assume, since this is profit after tax, out of profit after tax, there could be an appropriation of dividend made by a company. This is a company. So obviously, it would be any type of dividend, preference dividend or dividend for equity shareholders. So obviously, 73,000 rupees is missing, and that 73,000 rupees is nothing but dividend paid. You can assume in that way. Fine. Now see, look at it. The dividend paid is 73,000 rupees. This is how you can simply calculate. Now again, go back to the income statement to find out the funds from operation. Operating profit 1,10,000. Shall we take it as it is? You can take it as it is in the absence of depreciation, which is operating expenditure but non-fund expenditure. But here in the problem, you find 20,000 rupees depreciation recorded. Therefore, along with the operating profit 1,10,000, you add 20,000 rupees depreciation, which is a non-fund expenditure. Though it is an operating expenditure, it is a non-fund expenditure to be added with the operating profit. Therefore, you get 1,30,000 funds from operation. Then Anything over here with regard to the application of funds or sources of funds to be recorded in funds flow statement, share capital, there is no change. Bank loan, you see 15,000 rupees increase in bank loan, that is nothing but new loan borrowed. So 15,000 rupees new loan borrowed is a source of fund. Then come here, regarding fixed assets, we already opened a ledger account and found out there is a purchase of fixed assets. Then here, no, there is nothing. So preliminary expenses is already considered here. You can leave it. It doesn't come to influence your answer here. So come, let's look at the funds flow statement for the year 1999. Sources of funds. Funds from operation, I told you to calculate it. Operating profit plus what? Depreciation, it comes to 1,30,000. Bank loan taken, that also I explained, 15,000 rupees. Total sources 1,45,000. Fixed assets purchase according to the ledger account 30,000 rupees. Tax paid, we found out the amount of tax paid through the preparation of provision for taxation account, it is amounted 17,000. Dividend paid, we calculated because there is a mismatch between the figures of P&L account. So we found out the missing figure as what? A dividend paid 73,000. So total applications comes to 1,20,000. Total sources comes to 1,45,000. So here increase in working capital we found as per the schedule of changes in working capital prepared, it comes to 25,000. So obviously now the funds flow statement is tallied. You find there is a good match between sources of funds and application of funds. So this is a different type of problem. To gain more understanding over funds flow statement and the procedure to be followed for preparing funds flow statement, watch my other videos as well. Thanks for watching this video. Have a happy learning.